welcome to this webinar. I think I titled it, What Results Angels Should Expect Based on Data Analytics. I would like to do a little bit of an introduction. So let me start with our usual way of talking a little bit about the AOA, who we are and what we do. As everybody on this call probably has heard and knows well, the AOA is at the center of the startup funding in the Pacific Northwest region. We not only are the largest angel capital in the Pacific Northwest with 140 plus members, but we also are probably one of the longest serving, and we have a mix of angel investors, including many of the area's best VCs and super angels, prominent family offices. And we are also the #1 funder of women-led startups in the Pacific Northwest, which we're very proud of. We fund the most deals. AOA invests in over 20 deals per year with a total investment of over 10 million per year, more than any other angel group in our region. 40% of the companies that actually make it through a screening and present to the organization get funded. And an average amount invested per deal ranges between $250,000 and $500,000. We invest, we're not sector specific, we're sector agnostic. We invest across all sectors. One of the things we've learned over time is having the AOA in your, as an investor in your company builds credibility for future fundraising. We like to consider ourselves professional investors, and VCs consider us that way. So having the AOA in your deal is a good thing. The number of area angel groups also attend our meetings, like Bellingham Angels and others. And 80% of the entrepreneurs who received AOA funding successfully completed their funding rounds. And one of the things we're most proud of is that we can help with more than just money. The AOA members have deep business experience in a wide range of sectors and disciplines. Many of
Okay, so here are the documents, but you guys headed right there? Or you're gonna
whoever who's not muted, please mute. And if you don't, I will mute you. And then we not only help with funding, but we give invaluable business advice and connections. So I am really pleased that today we're able to present this brand new data that just came out of the Angel Capital Organization by two of my dear friends, John Harbison and Rick Timmons. John is a longtime member of Tech Coast Angels in LA. And Rick was one of the founders and long-term member of Central Texas Angel Network, two of the best angel networks in the country. And so having said that, rather than me spend a lot of time introducing them, what I'm going to do is turn it over to John to introduce himself. And I see Rick is now on, I believe, and let Rick introduce himself as well. So John, it's all yours. Take it away.
Okay. I see a Rick on that's muted. Is that you, Rick Timmons?
No, it's not. This is Rick Comfort. Sorry. I can do an intro, but it's probably not what you want to hear.
All right.
Rick
Timmons is on.
Timmons is also on now.
Are you on, Rick? Okay.
Yes, I am. I'm
Video.
so sorry.
Okay, good. We're all set then. So now let me see if I can get this to move. So just thank you for the introduction. We're very pleased to be here. Our three angel groups are, among, 3 of the top 5 in the country. We all, serve a lot of entrepreneurs in our respective geographies, have been around for a long time. We certainly hold more in common than we hold different. So big believer in sharing, best practices and what we've learned across all that. Rick, do you want to introduce yourself?
Yeah, sure. So as the chart says, I am Rick Timmons. I'm part of the Central Texas Angel Network in Austin, Texas. I was the board chairman for that group for 8 years. No longer a board member, but I am still a member, obviously, of CTAN. Joined the ACA board about 3 years ago. And for the last 3 years, I've been the chairman of the Data Analytics Committee. We're going to talk a little bit more about that in the next several minutes. I'm glad to be here. We are an active group, just like Alliance of Angels and Tech Coast Angels. And we've learned a lot. We're going to share some of it with you today.
And I'm John Harbison, and I've been involved at Tech Coast Angels since 2003. I served at one point as their chairman. And as Rick said, we both serve on the board together and the data analytics committee together. Last year, Tech Coast Angels did $19 million of investment across 64 companies, which was about the same as the previous year, which jumped up from about 11 the year before that. We have about 450 members. So without further ado, let's kind of get into the substance. At the ACA Data Initiative, we are in the process of trying to collect information and centralize it across angel groups. Rick can talk more to where we stand on that, but what you'll see today is insights that we've all learned from, looking at pieces of the elephant, within our own portfolios. And we're both very excited about starting to add experiences of other angel groups so that we can start to, see whether, validate what we've already seen. We publish a monthly data insight, basically a little thing you can read in 2 minutes with a chart and a little commentary. If you're not on the mailing list for the ACA, you haven't seen them. If you'd like to be on it, just sign up at ACA. You as members of Bay of A are also an ACA member, so it's easy to do that. This year, for the first time, we published those monthly data insights into an annual publication. And what we'll be showing you today are the charts from those first 18 months or so of those monthly things, including what was in the PDF, which is available for download at ACA, as well as the first 3 or 4 this year. So we're continuing to do that. These data insights, as you see on each one of them, are authored by different people from different groups. Dan has been gracious enough to do the one for next month, so don't miss that one. But these are the general topics that we'll go through as we organize some of this stuff. So starting with valuations and patterns of angel investing, I'll turn it over to Rick, and he can talk to you a little bit about a couple of surveys that he did last year on the COVID-19 feedback.
Well, thanks, John. So we did, as the ACA, at the onset of the pandemic back in March, April, we did a survey of our angel groups, and we got a very good response rate to that. More than 70% of the groups that we sent out queries and questions and survey to responded. And at this time, think about this. Now, this is going back a year or more, this is going back 14 months now. And we were asking the groups a question: what do you think is going to happen to the investments in your group? About 50% of them said it was likely to be down from year over year through at least April. And then as they looked throughout the whole year of 2020, they thought about 60% of the groups were going to actually have that in their angel groups investment totals look negative year over year for the whole year. So if you fast forward to the next chart, John, we actually asked the groups again a survey. We actually broadened out the survey, so we got much more responses in the October survey that you see, the September survey that you see in blue. So that was representing about 3 times more angel groups in that September survey than we had in the April survey. But look at the differences. So you can see only a third of the groups, fast forward 6, 7 more months, only a third of the groups thought that they had a chance to have their angel investments actually decrease. 40% said it was going to be about the same, and obviously the remainder was going to have an increase. So we can conclude from this survey, again in March and again in September, their groups adapted. They learned how to change. They learned how to go online, obviously. They learned how to conduct due diligence online, and they learned how to invest in a virtual environment. Now, we're all obviously getting back to our in-person activities as we speak, but this is an indication that the adaptability of the angel groups was pretty good during the course of the pandemic that we experienced. And again, if you want to see all the details of these surveys, you can go to the ACA website, click on the data analytics tab, and it will take you to about 30 charts each per survey that we shared with ACA members. Again, you're only seeing one chart from each of those surveys with this information. So here's another set of metrics. This was compiled by Roberta Garvin, a member of the Boise Network, and she looked at data with respect to the age of accredited investors and angels. You won't see much difference here. Obviously, those that are calling themselves angels, many of them are accredited investors, but their age disparity between the categories there, frankly, is not very significant. So if you go to the next chart, you start to see the obvious. And this is what we obviously as angel organizations see, is that the age of angels versus entrepreneurs is quite different. We see much more younger entrepreneurs, those that are applying, many of us, in many cases, to our angel networks, are in that 30 and 40 category, and much more older, frankly, in the age categories of 50 and above that you see are entrepreneurs. So one of the things that we've learned from this is that we need to cherish, so to speak, the angel investors that come to our organizations that are much younger than most of us in these angel groups. And we have to find ways, I think, also to try and attract a younger group of angel investors into our community of accredited investors, because it's much easier oftentimes to relate to entrepreneurs when one of the things that is much more relatable is the age of them. And this is a learning. And then you can see finally, we did look at she did look at some data with respect to households in the different age categories that cross over that accredited category, which allows them to be considered as angel investors. No surprise, obviously, that wealth accumulates as we get older. And you can see it's in the 12 to 15% range once you're over 50 years old. So again, cherish young angel investors when they have an opportunity to apply to your networks, and maybe even develop some strategies and some approaches that would attract them. So another thing that Roberta did in this next chart is to look at where we as angels are investing compared to where VCs are investing. So the geographic map of the United States and Canada is where the percentages of angel investments are being made across the country. You can see much, much lower in California at 12%, and much higher around the country. And this comes from the Angel Funders Report that we published in the fall of last year. Again, go to the ACA website. You can read the whole report. Again, this is data from those organizations that responded to the Angel Funders Report, and we had quite a bit of them. But compare that to what you see on the right. This is where VCs are investing, or at least their geography or location is centered. No surprise, for over 40% of our investable VC funds are on the West Coast, compared to 17% of our angel member investments. So the conclusion or learning that we're seeing from this is that as our portfolio companies look for A rounds, and certainly by the time they get to B rounds, they have to go elsewhere, generally to the West Coast, to try and obtain funding from VC organizations. Because look at the Southeast, 22%, Texas 9%. So that geography is over 30% of angel investments, but it's much, much less than 10% of the total VC funds. Again, what we have to learn as angel investors, as we grow our portfolio companies, is to look for follow-on round investing with VCs in other geographies, generally outside of where we are located. So how we develop networks, relationships, both at the entrepreneurial level and at the angel group level, is very important. And the learning from this is, let's learn how to do this and develop some best practices around that. I hope that makes sense to you. Now we have some data to support what we always thought or knew was happening to us.
So the next few slides are talking about what's happening in terms of valuation trends. This chart, the black line represents the TCA portfolio, the new investments and follow-ons in each year. And the green line comes from that Angel Funders report. We haven't published the 2021. As you would expect, everything's pricier in California. So the valuations we pay, largely driven by Northern California, setting the price is a little bit higher than the others. But either way you look at it, it has been rising significantly since 2016. And in my mind, it's gotten to a level where it's almost absurd, the kind of valuations in 2019. As Rick talked earlier, in 2020, when the stock market crashed, that's usually the thing that starts to bring valuations down. And there were certainly expectations of that. They did come down a little bit in 2020 from about 9 million on average to about 8 million. It'll be interesting to see what happens in the rest of the country. If you look at that and you break it out by percentile, the dark line in the middle is the same one you saw in the previous one, but this shows you the spread between the 20th percentile and the 80th percentile. But all the percentiles have been drifting up over time and have roughly doubled. And the 80th percentile has gone up to where it's about 16 million. If you ask most angels in our group 3 years ago, would you invest in any deal over $10 million? The answer, we say no, but we actually do a fair number of deals in that category these days. Some of that is due to the mix of follow-on versus new. The increase on the new has been a little bit less. It started out about 4.5 million in 2016, the blue line, and 2020 it's up about 6.5. So it's not as much of a doubling, but it certainly has increased. And the follow-on rounds have gone up quite a bit, the valuations of the later stage companies that we are investing in. Now we are defining a new round as one that's new to TCA. It may not be the first round for the company, and a follow-on we're just categorizing it's already been to TCA before, and this is follow-on financing from whatever sources, whether they're from members that were previously in it or whether they're members that have chosen to come in at a later stage. We did a survey of the TCA members last May as well when COVID was happening to try to get a sense of our members. And the expectation at that time was more than 2/3 of the members expected valuations were going to drop. This is, the stock market hadn't recovered yet at that point. And it was expected to drop pretty significantly and more akin to what happened in the 2008 to 2010 cycle and in the 2002 and 3 and 4 cycle. And so some of that's happened, but as the stock markets fairly quickly recovered, I think those valuations didn't happen. The next set of slides talk about investment strategy and screening and due diligence and what we've learned about that. And I'll take this next one. This is a chart that comes from Launchpad Venture Group in Boston. Christopher Mirabile, who is one of the star angels out there. Many of you know Christopher. He's published multiple books. He was just selected for the Hans Severn Award last week as the Rock and Roll Hall of Fame of angel investing. So he is somebody we all look to, and he takes a very data analytics approach to the management of their portfolio. And you'll see some of his charts in this deck. This particular one looks at companies. They've turned the logos into not real logos just to keep the confidentiality of those companies. But each one of those logos represents one of their portfolio companies. And it compares at the beginning, at the time of investment, how they assess technical risk and then go to market adoption risk, and whether it was a mixture of the two. So the ones on the left-hand side, the top bar or the top layer, are companies that's primarily technology risk. And the bottom layer is primarily market risk. In the middle was a mix. And you can see there's a pretty good correlation here. The ones that were primarily technical risk, that's where a lot of losses occurred. The ones that were primarily market risks, that's where a fair number of the gains. But the mixed ones where there was both technical risk and market risk, you have some wins and some losses, but more wins than losses. I'll turn this back to you, Rick.
Can I interrupt for a second? Ask a
Yeah.
question there. Do you see any correlation to bigger returns for ones that you maybe got into earlier and had some technical risk?
There's a chart later on that talks about returns on whether it was an M&A or an IPO, and some of that relates to the length of things were out there. I don't know specifically in this portfolio. Christopher on the call, he probably could answer that question, because he does cut things different ways, but I haven't seen the answer to that question. It's a good question. I'll turn it back to you, Rick, to talk about the relevance of experience in the CEO at the time of investment.
Yeah, so we often hear the notion that experienced CEOs outperform first-time CEOs. I think anecdotally, we believe that, we all do. So we in CTAN went out and tried to look at the data to see if that is true. So we looked at our portfolio of investments. This goes back a couple years, 174 investments. And we only gave the check mark to a CEO of one of our companies if they were previously a CEO. So if they were the CTO, if they were the VP of sales, they did not get the check mark for an experienced CEO. Only a CEO previously had done it. In our portfolio, there were 27 CEOs or in companies that qualified. 147 obviously were first-time CEOs. Let's look at the data on these two charts. So the left-hand side is some data with respect to the experienced CEOs. The right-hand side, first-time CEOs. Right off, it jumps at you that the valuation multiple of our CEOs experienced is almost 5x. Compare that to the first-time CEOs, 1.7x. Clearly much, much higher. If you look at the first green bar, how many of these CEOs are out of business? Only 11% of the experienced CEOs went out of business. A third of the first-time CEOs have gone out of business. Jump to the far right-hand side of the green bars. 37% of our experienced CEOs have already experienced an exit versus 12% for our first-time CEOs, 3 times higher for experienced CEOs. So clearly, our conclusion is based on the data. Yes, experienced CEOs generally outperform first-time CEOs. Now, that's not to say that we don't do investments in first-time CEOs. And John's going to tell me about Steve Jobs and Jeff Bezos and all of those folks. I know. But this is a very important metric to consider. It's not the only one, and certainly many others that need to be evaluated, but this is an important metric that we all need to look at and think about. Now we have data to support it. Another metric we wanted to look at within CTAN is we have a process that we go through. It's a vetting process where members vote to go to a screening meeting. Once 50 companies apply to us every cycle, 10 or 12 come to the screening meeting, 4 or 5 go to the next meeting, which is pitch day, and we do investments in 3 or 4 companies out of the cycle each time. So we do 25 new investments a year about. So we wanted to say, okay, let's go back and look at some data. Here's some data from the fourth quarter of 2011 through 2014. You can see the dark green bar is in that time frame. We invested in 56 companies through the process that I very, very briefly described to you, but we passed on 112 of those companies. We said, no, we don't want them to come to the screening meeting or pitch day, or we're not going to do diligence, and we're not going to invest in them. So I kept all of that data. And I said, how are those companies that we in fact passed on, did not invest, versus those that we did invest and decided to write checks because we did some good due diligence, we did some very analytical things with that entrepreneur, wrote the term sheets and invested. The middle bar is perhaps one of the most telling ones. 70% of those 112 companies in that window. So we've had some time for them to carry on, so to speak. 70% of them are already out of business versus only about 40% of the ones that we did invest in. Clearly, a much lower percentage compared to those that we invested on. Look at the bars on the right. 26% of those companies in our portfolio that we invested in have already exited. 5% of those companies that we passed on have had an exit. So yes, we missed on 5 companies, but clearly we think our due diligence is doing well enough that we are able, through various processes that CSAN hands and our due diligence, we're able to screen out a lot of companies that we should not be investing in. So the conclusion that we came from with looking at this data was that our due diligence is important, it does matter, and it's making a difference. So I think it's an important metric.
So you want to
Another-
go ahead.
Is there a question or something?
No,
Comment?
go ahead, Rick.
Okay, I'm sorry. Okay, so another thing that we looked at follow-on investing. And we tried to look at it with our outcomes and our shutdowns. So we said, are we doing the right thing with respect to follow-on investing? You can see in this window of time, we had 29 exits. The first bars that you see, 17 of those, or the great majority of them, we did have follow-on activity. 12 of them we did not. I'll come to the percentages in a minute, but look to the bars on the right. Those are the companies that went out of business. There's 55 of them. We did follow-ons on 17 of them, much, much less than half of them. And we did no follow-ons on 38 of them. So our conclusion is we think we're doing, for the most part, our members are doing follow-on investing for the right reasons. Obviously, there's lots of situations that cause companies to do follow-on investing. We think we're doing it for the right reason because the great majority of time when our companies are not doing well, 2/3 of the time, we're passing on those companies, not doing any more follow-on, we're done, one and done. The great majority of companies that are doing well, 17 out of 29, we are doing follow-on investing. And then finally, if you look at the metrics, the internal rate of return of those 17 companies with follow-on rounds of investing, the internal rate of return is 5 times higher, 54% internal rate of returns versus only 11% for only 1 round of investments by our members. So clearly, again, when companies are doing well and for the right reasons, we're putting money into them and we're achieving good returns and excellent returns, especially compared to those where we're only doing 1 round of investing. So it's a good learning for us. And then another diversification activity that we want to look at in CTAN is the diversification with respect to vertical industries or business segments. In CTAN, we break our companies into 5 segments. You can see them going across on the bars down below. Business to business software, business to consumer software. Very, very different, we believe. Hardware and other, life science companies, and consumer product group companies. You can see the numbers in parentheses are the number of companies in each one of those SIGs or special interest groups that we call them. And now look at the money, the dark blue bars that we've invested in those particular SIGs and the valuation multiples of each SIG. Our highest performing one, life sciences, at just over 3. And by the way, this includes companies in the portfolio and still in business. We do a valuation estimate for those, and those that have exited also. And frankly, those that have gone out of business. So it's a cumulative of all 3 of those types of companies. Business to business software, 2.61. And our most challenging SIG is business to consumer software. Just over 1 is the valuation multiple, and consumer 1.65. So clearly, we all know that it's hard to get on the shelves of grocery stores or wherever. SIGs, the consumer product SIG, is challenging for us. We've done a lot of those companies, 28 of them, but the valuation multiple, 1.65, and business to consumer software, 1.11. So one of the things that we've learned from this particular chart is we think it's important to have diversification, not only in terms of the number of companies, but also in the types of companies. I'm a tech guy and I'm familiar with software up and down, left and right. But some of my best performing companies in my personal portfolio are in life sciences, because I've been able to rely and utilize the due diligence from our members who are proficient and skilled in that particular SIG group. So diversification with respect to the vertical industries of companies is also an important consideration we have learned.
Rick, I'd like to ask you a question on that, if I may.
Okay.
For those of us that don't invest in Texas or haven't invested in Texas, does this sort of reflect, is there a specialty in Texas that you think is particularly strong as a segment? Does your return sort of correlate to those areas where, as a geography, you are stronger?
Yeah, so I've looked at this in other geographies too, Dan, and I see in other geographies, not just in Texas, and here in Austin, we have probably an overabundance of software companies compared to probably most other regions of the country. But I've seen the life sciences and the business to business software performances as good as these are in Texas. I've seen them in other regions too. So I think, I don't think this is unique to Austin or Texas. I think this is becoming a pattern that I'm seeing more often in other angel organizations and groups across the country. These 2 sectors in particular, or groupings.
Okay, a couple slides here that look at returns, capital raised and exit value for M&A transactions and contrasting that with IPO transactions. We're all chasing our unicorns, but what actually happens in terms of returns? Well, it is true that the orange bars are the IPOs and the blue bars are the M&A amounts. So if I read across from the bottom, the median capital raised for the M&A is $15 million. The median capital raised for an IPO is $103 million. So it's almost 7 times as much for the ones that have gotten to an IPO. The exit values are also higher, but not quite as higher, 4.3 times higher in terms of median exits. In terms of the average capital raise, they're both at about 5.8 times a difference. But if you look on the right side of the chart, you'll see that the multiples on the M&As, the multiple realized is actually higher for the M&As than for the IPOs. And they're about the same for the IPOs and M&As. So in terms of capital efficiency, the ones that are M&A transactions tend to be more capital efficient, smaller outcomes, but angels still tend to do pretty well in those kinds of deals. And if you look at what's driving that is that the M&A transactions are companies that on average have 2.8 rounds of financing. The IPOs have on average 4.2 rounds of financing. So there are more rounds at higher valuations and 1.5 times as many financing events. Another question is, how do younger CEOs fare better than older ones? Well, Rick talked a little about experience, but what about just in terms of age? The next two charts come from some research that was done by several professors at MIT and Wharton. And they looked at the distribution of all the startups, very large set of, I don't remember the exact number, but there is a distribution obviously around the people that we see. And they separated out all those companies and the ones that got the top 5% in terms of growth achieved. And it was first interesting finding was that the median age or the mean age of the founders overall is about 42 years old, but the highest growth companies tend to be a little higher. And if you get into it, the data analysis they did, the conclusion was that a 50-year-old founder is 1.8 times more likely to achieve upper tail growth than a 30-year-old. And this is kind of the data that supports that behind that. So now when you think about, what's happening there, yes, there's the myth that, younger people are potentially sharper cognitively, less distracted by family and other responsibilities, and maybe more capable of transformative ideas because they're not constrained by the way things are being done. But obviously offsetting that is an experience factor, that we all make mistakes as we go along. We hopefully learn from those mistakes, and we can do potentially a better job of avoiding those mistakes in the future. And even somebody like a Steve Jobs, who we all would aspire to have his kind of track record, he made some pretty big mistakes along the line in his career. A couple that kind of come to mind for me was that when he went to Next and he was developing a NextCube workstation that costs $14,000 in today's dollars for students, it didn't sound like a really good investable proposition. But IBM went to him and said, if you just get out of the hardware business, we'd like to license your operating system. We're not terribly happy with Microsoft. We'd like you to be the operating system. And he turned that one down, gave Microsoft a little bit more breathing room. And then later on, when he was the owner of Pixar, they were trying to sell software and not being very successful at it because there weren't that many customers, and it was bleeding red ink all over and was running out of funds. And so he told the person who was running it to let this small team of 5 people that was creating content go because they weren't producing any revenue, including John Lasseter. And the person who was running the company nodded his head, went back up to Marin County and didn't implement the instruction. And a couple of weeks later, they won the Academy Award for Best Short with Pixar. And it made it hard for him to do that. And obviously Pixar became a big success, and Jobs made more money on Pixar than he ever made on Apple. So another thing that we look at is, I mentioned before, the Launchpad group. This is another member of the Launchpad group, Alexander Brown, put this analysis together. They really do a great job of doing due diligence and then staying in touch with companies throughout the life cycle of the company and give them advice to go along and help them prepare for exits and so forth. And they went back to look at what was happening at the beginning of their rounds and asked a few fundamental questions, and then see what the return in their portfolio was based on those companies. So there are 105 active companies in their portfolio. The first question was, do they lead the round or not? Well, they earn almost a 3.4 or 5 return when they lead the round and only a 1.4 when they don't. So it's 160% higher. The second is they go through an extensive due diligence process. If they meet all of the due diligence tests and they do all the steps they normally do, again, they have a 50% higher return. The third is a measure of capital efficiency going through a model they have. And again, those are higher returns. And the last question is, do they have a board seat? And they do 20% better where they have a board seat. So some other indication of some best practices that seem to influence returns. Next, we'll talk a little bit about exits and what to expect in terms of exits. I shared these slides with some of you last summer when I was giving you a presentation on Tech Coast Angels, but I'll just quickly review it here. Often angels get discouraged because we make a few investments. We don't hear much in terms of outcomes. We're more likely to hear negative news than positive news. So we think must not be very good at this, and we give up. Well, this takes a look at the whole portfolio of outcomes. So let's look at the first 180 outcomes for Tech Coast Angels. About 70 of those were ones that returned capital, and the rest were total shutdowns. And then looks at the distribution on the years from the point of investment. So normalizing for the life of the company at the time of the exit. And you can see in the first 5 years, yes, we do have a few exits, but there's a lot of shutdowns, particularly in the 2 to 4 to 5 year period. Most of the news is bad news because those are the companies that, for whatever reasons, failed to meet the objectives, whether it was development or the customers really didn't like it, and so forth. But once that shakes out, it shifts around, and they're mostly green bars beyond that, which is most of the outcomes are positive outcomes. And the other thing that happens is they also tend to be larger outcomes as you go further. If you take just those positive outcomes and you break it in terms of the multiples realized, those exits in the first few years tend to be modest size exits, 1x, 1 to 5x, occasionally something 5 to 10x might slip in there. The ones that really drive the overall performance on our portfolio are ones that we didn't start getting them till about 5 years out. And then we had another few that came around 9 or 10 years out. So it takes longer for those companies to mature. Several of those later ones were IPOs. It takes longer for a company to get to significant revenues and cash flow positive and the things that they're looking for in terms of positive outcomes. And if you invested in the whole portfolio, this analysis was done a couple of years ago. If you invested in all of the TCA companies that either exited or shut down at that point in time, you'd have a 4.8x multiple. But if you looked at when you got that money back, after 4.5 years, you would have just gotten your money back. You still wouldn't have earned a return. Most of the return came later on. Since then, we've had a few big successes and some failures, and that 4.8 is up to about 5.3 for us. But it is front end loaded in bad news, and the good news comes later on. So companies can hang on past the first 5 years. Usually they will get to some kind of an outcome, and often it's a very large outcome. So now I'll turn to returns.
Sorry, I can just raise my hand for a sec.
Yes.
Just asking about the average time it takes for an outcome. I think the ACA estimated that's 4.5 years. Did that jive with your data? Irrespective
we
of the
have
size.
Tech Coast Angels, it's same thing. It's like 4.5, but that's a very misleading numbers because the first few years are mostly negatives and the positives come later, and a lot of the positives come much later. We had one year before last that was 18 years in the making. And still the average was 4.3. So that came out of an analysis that was done by Rob Wiltbank, an ACA. And I think it's really done disservice because people expect in 4.3 years, they're going to know where they stand. And most likely, you know which ones failed at that point, but you really won't know which ones succeed.
Sure.
Well, let me give you the data for the Central Texas Angel Network. We have through 2020, we have 60 companies that have gone out of business. Average length of time for those 60 companies to go out of business is 3.8 years. We've had 42 exits. The average length of time for the exit to occur is 5.1 years. So it's not quite as long as what John is seeing here in Tech Coast Angels. We're on average 5 years.
Yeah, you've done better in the early years than we did.
Right.
So let's talk about returns. This is another chart from Launchpad Venture Group from Ham Lord and Alex Brown. And this one looks at their returns by year that they invested. And they had a very good year from the 2009 class, which was obviously in the depth of a recession. And so you could say there are opportunities at that point in the cycle, which in my opinion, we will be at that point in the cycle in the near future. So there often are some good investments to be made at that point in time. The other thing is it does take a while for these things to happen, and the returns go up as those things happen. So some of the, you could also say that it takes 6 or 7 years for that to occur. It'll be interesting to see as this develops more beyond that. Another question that we looked at was, how do angel returns compare to venture capital returns? Obviously, angel returns are very concentrated on a few big home runs. The same's true for venture capital. So this chart looks at the distribution of return of companies in terms of dollars by which ones got less than 1x back, including the shutdowns, 1 to 3x, 3 to 5x, and so forth. In the middle of this chart, the green is the VCs and the purple is TCA. So we're very similar to the VCs in the middle of the chart. We do worse than the VCs in the less than 1x, partly because we're investing in earlier stage things and more things go bust in that end of the portfolio. And the VCs have had a chance to wait to see things come out. But we also do better at the other end of the spectrum in terms of when we have home runs, they tend to be really big home runs. So we've had 3 IPOs, one at 75, one which got to 75x, another one got to 260 some, and the other one got to 235x. And so that our portfolio is driven by a few of those big home runs that were significantly bigger than the VCs are typically seeing on their returns. Rick mentioned diversification in terms of industry. The other dimension of diversification is how many investments that you make. A couple of years ago, we did a Monte Carlo analysis of the first 160 outcomes, and we took 20,000 potential portfolios and looked at differing number of investments, what your return would be. And so the way this chart reads is that you have a 26% likelihood of being in that blue area, of having a 0.48 return or more. So even though the average is 48, if you invest in all 160 of those companies, if most people don't invest, nobody invests in all those companies. And so the distribution ends up being skewed. If you do the same thing for different portfolio sizes, you can see that on the top, if you only invest in 5 companies, you have a 2/3 of a chance of getting a 1x return. And obviously, third of not even getting a 1x return. And as you invest in more companies, there's greater certainty that you'll at least get your money back. And similarly, if you look at the average industry return for angels, 2.6x, you'd only have a 40% chance of doing that with 5, but it goes up to 79 if you invested in 50. So diversification is something that gives you a greater probability and greater certainty on returns. Another way to look at diversification is another analysis from Alexander Brown of Launchpad. They looked at, they have 278 investors, and because they monitor all this in Saraf, they know what that is for each individual investor. So it's all anonymized data, but this chart looks at how many companies those people invested in, and the circle size is how much they put in total across all those companies. The red line is the median IRR of those companies. And obviously this whole thing is being measured, the size on the horizontal and the IRR on the top. So when you get into 5 or less companies, there's a huge discrepancy from 100% higher, 100% lower, and whether you happen to pick a winner or loser. As you start to go from 5 to 10 to 15, those things tighten. And the other thing that's patterned is that most of those circles are now positive returns, and they tend to be, significant, get closer to the median IRR as you do more deals. And this is that same chart. So the investors with 25 company portfolio have 4.5 times the IRR of the ones that have a 1 to 5 company portfolio, and they have 1/12 the variability of returns. So diversification is something that's definitely worth considering. And also a lot of groups are doing funds now, either sidecar funds or investing only through funds. And that's another way to get this kind of diversification.
So I was going to ask that question, John. So if you have a fund, is the implication that you need more companies, more than 10 companies in the fund, to sort of begin to get a good return, or at least recognize the kind of IRR that you're projecting from this simulation?
Yeah. So if you were a fund, same thing. If you were a fund of 5 investments, you would probably look like similar to an angel who invested in 5. If you're a fund of 35 investments, you'd look like the 35, and so you're more likely to realize those returns. Now, obviously, how the fund decisions are made, do have a factor in this. And I, for one, have been trying to encourage my colleagues at Tech Coast Angels. We have sidecar funds that are variations on wisdom of crowds, where the majority of the investors have to support it for the money to go into the fund. And the reason I'm a little skeptical of that approach is if I look across our portfolio, one of those 4 big home runs was a large investment by a lot of people in Tech Coast Angels. That was a company called Green Dot and prepaid debit cards, which went public at 110 and got up to about 235 or so. The others were MindBody, which we put maybe 200, 300,000 in, Sandpiper, which was probably only 50 or 70, and TrueCar, which was an IPO, and we put 75 into that. So if you just took those 4 outcomes, and my guess is they never would have made it into our funds, 3 of the 4. So if you'd invested equally into all the ones that met the basic criteria to be a TCA portfolio company, which is you have to present to us and you have to go through a due diligence and you have to have at least 2 people invest for a minimum of 50,000. I think that fund will do better going forward, just as it has done better in the past. But still get a lot of pushback from my colleagues that says, well, I don't necessarily trust that new member who doesn't know what they're doing and blah, 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 blah. Well, the biggest success we had last year was a company called Companion Medical, which makes a product in the insulin monitoring space. And we had 2 investors in that, and it was a 58x exit after 4 years. And one of those 2 investors, it was his very first angel investment. So I don't even buy that, only experienced angels can make good investments. You can get lucky on the first one too. So I think that's, that would be an interesting fun to do, but we haven't, gotten to that one yet. So that's the end of the slides. I'll pause if there are any other questions, or if you have any other questions that we haven't covered, Rick and I can, decide if we have, other data that we can share with you, and I'll stop sharing the screen here now.
I was just going to say, apologies for not showing my video, but if you were to go back 2 slides, and there's no reason to do that, but if you were to go back 2 slides, there were some large circles along the relatively few number of high return investments. And, the obvious comment is those are the individuals that you would like to index your fund to. And I'm not, so I think that the balance between a central tendency of the return through diversification and through the wisdom of the crowd versus obviously you have some people in that group who are large circles who are making the right decisions on relatively small numbers of investments. And I just want to point out, and that is actually where the highest returns
Yeah.
are found.
And
So,
that's certainly when you pick a mutual fund and you decide not to go in an index, and you believe in the Magellan fund because the guy who does the Magellan fund is a good picker and might do better in the future than or as well in the future than in the past. Doesn't always work out that way. One of the things we try to do is we try to find those people who have had good records, and then we have educational sessions where they say, okay, share your wisdom on how you do this. And I remember one of them was a member in our Orange County chapter, Steve Frenzinger, who at the time he gave an educational session had done 15 investments, and he had 6-7 figure returns. That's a lot better than I'd done with my first 13 investments. And so his clue was he did it all, not just on the jockey, but the psychological profile of the jockey. So he went back to the Myers-Briggs 4x4 matrix, and there was one column in that matrix that he decided was the right characteristics for a CEO, and one particular cell in that, which was the optimal, but he said that there are only like 3% of the people who present that are in that. So he had his bandwidth. So I think we can all learn from each other and adapt those learnings and become a better investor. I think I'm a better investor now than I was when I started out 20 years ago. But I also am humble enough to know that I actually will probably know what I'm doing when I'm 160. So anything we can do to accelerate that learning is good. I've had the luck or misfortune, I guess, I've had 5 companies that were over 100x returns, but they're all public companies. One was Microsoft, which I invested in 86 and sold the last shares for 1,100 times what I bought it for. I bought Apple in 84 and still have a bunch of that and sold some of that for 800 times, and 3 other companies like that. But most of my money that I make new investments today, I put in indexes because I don't have confidence I'm going to pick the next Microsoft or Apple or Nucor or Abbott Labs or McGraw-Hill or some of the ones that I've had those kinds of returns before. So past performance is not necessarily indicative of future returns, but that is certainly one philosophy you could do and create an index. And maybe if you take all those circles at the top and collectively across all of them and put more weight in that, you'd have a better outcome there. But thank you for the question, Bill.
So John and Rick, this is for both of you, but if you were to take an index of all of the TCA or C10 investments, what I take it you're looking at like about a 4.8x ROI?
Well, all of the TCA ones, if you'd invest, we've had now up to about 210 outcomes. And if you'd invested in, we have 450 companies invested, so that we still have half of them that are active. But the ones that have had outcomes, if you'd invested an equal amount in every one of them, you'd have 5.3 times back at this point, and you'd have all the other ones still as active portfolio companies. So after half of your investments were resolved, basically, you'd have 5.3, and who knows whether the remaining ones are going to live up to that.
For C10, I have looked at that, and if you put an equal amount into our companies that have gone out of business and have exited, an equal amount over all those years from 2006 to 2020, the return multiple would be 4.4.
I think you had, this is Steve Buxman, just a quick question if I may. I think you had a chart that sort of addresses, so let me try to ask the question. What is the relative return of the first stage and second stage? And maybe to make it more pointed, if I had $1 million and I invested it in some fixed amount across all first stage investments and the same $1 million, all second stage investments, do you have the analytics to say what the relative returns of those two are?
Well, Rick presented some of that in comparing the companies that they had made follow-on returns, but didn't specifically say what was the return on those people who had invested at the follow-on potentially at a higher value. When I first started angel investing, I didn't really know what I was doing. And my mentor was the founder of TCA, Luis Villalobos. And he told me, John, just invest in the first round and keep investing in the first round. If it's a big hit, you'll do fine. And don't worry about the follow-ons. And over time, I saw, and at that time, VCs were not very predatory in their pay-to-play cram downs and all that kind of stuff. And one by one, the VCs that were good partners to us kind of insulted us by playing games with changing the terms later on. So some of those later, that ultimately, would affect the outcome on the earlier ones. What I've seen in some of the last 5 or 6 years, I've seen a lot of these investments come to us as a new company. A bunch of people jump in the boat, then it comes back for a follow-on. More people jump in the boat, and this keeps going at higher valuations. And I had one of those that it came to us with a $700,000 pre, and a year or two later, it was a $3 million. And I got in at the $3 million level. And a few years after that, it was a $25 million. So those early ones did better, but it was too much risk for me. And so I kind of got in at a later point. I think what's happening now is that the return on those later investments, they're really not later stage companies, but those later investments is doing well because the valuations are starting high and then creeping up more slowly. So that for just a little bit more valuation, there's a whole lot of risk that's been taken off the table. So that a higher portion of those follow-on rounds will reach an outcome. And it may not be as high a multiple, but they'll reach an outcome. And so you end up getting a higher overall multiple and a higher IRR on those follow-on investments. Now, whether that will persist as we go forward in the future in terms of what's happening in valuations, but that's my observations. You want to comment, Rick?
Yes, I do. So a simple way of looking at this that I did for the CTAN portfolio of 42 exits. If those 42 exits, you did not invest in the seed round and you only invested in the follow-on rounds of those companies. And so you literally passed on the initial investment, but said, okay, it's doing good. I'm going to do the follow-on round. The return, the internal rate of return dropped by 2/3. So you had a positive rate of return, approximately 15%, but you missed out on the significant opportunity of gaining a lot by not doing that seed round. So you can do you can only do the follow-on rounds of companies doing well, but at least for the data that we did in CTAN, your returns were cut by 2/3.
It sounds like that's different answers from the two of you.
Yeah, and our big, I'd say that if I look at our big outcomes, they started at very low valuations. They didn't start at $8 million valuations. They started, $2 million valuations. And so if you're investing in those later ones, if you invest at a $20 or $30 million valuation, your chance of getting 100x return is pretty small.
That's right.
So I think that's why those early ones tend to prevail and why Lewis gave that original advice. I've just have seen, some, so I've sort of modified it. I sort of say, okay, I'm going to primarily invest in the first round that I'm comfortable with, which is usually the seed because I don't get scared by risk, but I don't tend to invest in the follow-ons, even if the company's doing well, unless it's a pay to play. If it's a pay to play and I still believe in the company, I don't want to get totally washed out. So I do that. Because I've had a couple that I did get washed out because I didn't do a later stage and that ultimately wiped me out and there was an outcome at the end.
Yeah, we educate our members, particularly new ones, to consider putting 40 of your investable amounts, soft circle 40 to 50% for seed rounds and 50 to 60% for follow-on rounds is how we coach our members.
So if I summarize that, it's sort of like I think you're more likely to get doubles and triples on the follow-ons. I think you're less likely to get home runs.
That's right.
So our time is up, but if you guys are willing to keep talking and people want to keep listening, I don't see a reason to cut it off now. So anybody who has to drop off, please drop off, but otherwise we'll keep going for a while. So some of your experience mirrors what we've seen. I think one of the differences in Seattle that we've seen is that we've had a lot of luck with consumer products companies. I mean, hell, we're the home of Costco, Starbucks, Amazon, et cetera, and they were all angel-backed startups. Of course, all three of them happened before the Alliance of Angels, but the people coming out of those have helped us with deals. Some of our very best deals were consumer products oriented things. That's why I asked about expertise in the area. And we have not done as well with the biomedical things here, but we have a lot of biomedical startups here. And I think we just haven't had the understanding or wherewithal, or I don't know what the right term is, to invest in them.
Yeah, I first of all, I would take consumer products. I wouldn't put Costco in the same bucket as some new milkshake drink that, you know, somebody's trying to sell that's got all sorts of antioxidants in it. So the products themselves, if I look at our portfolio, we do a lot of investments there. And of all the industries, that's kind of the lowest return for us because it's a tough business. You pay a lot of slotting fees, and you know you can often get trial in Whole Foods, but to get the renewals, it's hard. And if you get through all that and you get the order, I've had 3 companies I've personally invested in that got the order from Costco, and it drove them out of business because because suddenly they had to, you know, fill 450 pallets of this stuff, and they didn't get to raise the capital. And the other part of the consumer products is that when you get a success out of that, the exit's $15 million or $20 million. It's not hundreds of millions of dollars. So I think those kinds of shouldn't be considered the same as a Starbucks or an Amazon or a Costco. Those are consumer retail plays that obviously have been very successful.
Yeah, the only consumer products in Austin that have done well, generally speaking, is alcohol. We've had Deep Eddy vodka, Tito's vodka, and we have a distillery in Austin that's currently still in the portfolio, generating about a current valuation multiple of about 8x. So other than alcohol, we have not fared well.
Any data on down rounds? Is that a 50-50 flip the coin, or are they generally good to get into, not good to get into, or who knows?
I think it's all the merits of the specific opportunity, you know, and when it happens. So often you're going to, when we hit this next down cycle, which at some point we're going to hit, there will be down rounds then. And, you know, that's very different than when you have a down round when the market and valuations are all going up, because there's much more of a taint associated with that.
Yeah, I would say our experience in CTAN with down rounds is not good, generally speaking. And we generally coach our members to try and avoid them and try and move on to the next opportunity.
Yeah,
Well,
by the way, Dan, your ask about, you had another part of your question, which I didn't comment on, which was the life sciences, and you have a lot of companies up there, but maybe not as many in the members. I think you make a better investment if somebody, doesn't have to be yourself, but somebody in your group does have the domain expertise that can ask the right questions. And there's a lot of analysis that we've done that shows that where the expertise is there in the angel group that makes the investment, you do due diligence much more efficiently, and you make much better investments. And we had we have several chapters, as you know, Dan, in Tech Coast Angels, and I'm in the Orange County chapter, and we've always had a lot of medical products companies, medical device companies in Orange County, but we had very few members. We had limited deal flow, and we didn't particularly make good investments. And we decided to do a big recruitment drive to get people from that industry into our group and creating a separate track. And we're seeing much better companies. We're making deals, and I think we're going to see a lot of good outcomes. But you need to be aligned with expertise somewhere in an industry to really make it all happen. And as you know, in the San Diego chapter, there's lots of life sciences expertise down there. And so it's kind of hard for somebody to pull a fast one on us when there's that many people who, you know, have the hard knocks of having been through the industry and know what are the right questions to ask. And they can also help coach the companies better and open doors.
I'd sort of also like to comment on our experience on down rounds. Our absolute best deal ever was probably a 2004 deal called DocuSign. And it raised money in 2005, and it was a down round. And a number of us doubled down because we still like the company. And then it raised money on back to the original price in 2006. And as of last week, if you held it, it was a 265x return after its IPO and appreciation. So I think that, you know, there's down rounds and then there's down rounds. Some down rounds are the company is really in trouble. And as an investment banker once told me, don't try to catch falling razor blades. But then there's down rounds where the company ran into some headwind, needs some more support and help. And, you know, that may be a good time to double down.
Yeah, and if you
the first time.
And if you're on your own 1 yard line with 10 seconds left in the game and you need a down round, you know, that's different than you're on the other guy's 1 yard line and the game's going to end and you want to live to play the last 10 seconds of the game. You know, it's a different, you know, kind of, so you're the part that was important is you still believed in the company at that time. So that's the important part of any of these investments. And then you really look at it at that valuation, given the risks that are out there. And often it is a good deal at that point. We had one that was out of San Diego before you joined there, Dan. It was called Drive Cam. And this was a camera that looked inside your car and told you, you know, whether you're falling asleep and stuff like that. And we developed it with angel investment to the point where it was profitable. And then the company took $25 or $30 million of venture capital. The venture capitalists came in, changed everything, changed the team around. They threw a whole bunch of, you know, Super Bowls ads at it, you know, all that kind of crazy spending, and drove the company practically out of business. And so they did a down round from, you know, $30 million was the valuation when the VCs came in to $1 million. And most of the angels said, I've had enough of this. This company was, you know, misdirected. But a few years later, it sold for $100 million. So the people who did the $1 million valuation did really well. And the ones that gave up didn't. So yeah, if you exit at the wrong time, I had one that was, I started with a $25,000 investment, went through 4 or 5 rounds, got it up to 42,000. And I just was tired of all these rounds. And I finally, one came along and I said, I don't want to keep putting money into this. And it was a down round. And I didn't invest, and I wish I had, because eventually they did turn it around and we're likely going to have they're currently considering a spin into a SPAC and it'll be a public company. And I'll be lucky to get my $40,000 back. But some people will get a very high multiple because they invested and didn't get wiped out. And it was one of these preferred, you know, you're preferred into 20 shares of preferred into 1 share of common things where you basically get wiped out. Those get pretty ugly.
One thing
What
we
about
didn't
this like
address
anecdotal?
was
Go ahead, Dan.
one thing we didn't address was economic cycles. You did show on the chart some of the launchpad data, I think, showed that investing in 2009 and 2008 was a really good thing. We have found that too, that after the 2000 collapse, there were some really great companies made. It'd be interesting to see, do you sense the same thing, that down markets are a great opportunity for investing, or is it somewhat
Well, I used to think that was the case, and I certainly, I would think that, because during the downturn, a couple things happen is that the ones that do get funding are really, the bar's been raised and they're much better. They've got a lot less risk and they've got a good team and all that kind of stuff. So they tend to be better companies. And the other part of it is the other companies that would have been formed to be their competitors didn't get funding. So they got a little runway. And the third thing is if they do require more funding, they can go back to the markets for their Series A, B, or C during the up part of the cycle when valuations are rising and capital tends to be available. So in theory, I think it should work. It didn't work with the TCA portfolio. When I did a chart over the 23 years or 20 years that we've been around, and I look at all our classes and looked at the multiples realized by classes, there wasn't a correlation between economic cycles and the returns, because it's too driven by the timing of when that home run happened to be gestated from, and if you happen to get lucky and one that was formed in the middle of an upcycle, you get through all that. So I think that it will be harder. The thing, what I'm doing in terms of my own personal investment is I'm very reluctant, having lived through 2 of these cycles, to invest in companies that require funding, a year from now to stay alive. So I've said, you may want funding a year from now and you may use funding a year from now, but I want to invest in companies that can survive if there isn't any money available and the banks all shut down and us get scared because the stock market's collapsed and we don't invest. Because in 2008, I had 2 or 3 companies that I believe passionately about that I think could have become unicorns. They all died because basically the latter stages of capital all clammed down and nothing was available.
Cool. Well, unless somebody has a pressing question, I'd like to end it here and thank both John and Rick.
Pleasure. I enjoyed it very much.
They're
Yes.
such good angels. The work they've done on the analytics is something we've all wanted and needed for years. And I applaud the 2 of them for taking this task on. For those who are AOA members, you should know we've tried to get the kind of data they've gotten. And John is being very helpful working with us to try to help guide us through the process. I hope that this inspires some people on the call to want to step up and help us with our data analytics to get the data. It takes a lot of digging and work and heavy lifting. And you guys did such a wonderful job to make this all come together. I know it's been a labor of love for about 4 years, John? And Rick?
Yeah, well, I got started about 6 years or so.
Yeah, I started CTAN Analytics in 2011, so it's been a passion for me personally for 10 years, all because my wife kept asking me, "How are we doing, honey?"
Yeah, and our members and prospective members were asking, and when we said we didn't know, it was a bad answer because it either meant we knew and it was bad, or we didn't know, we didn't care.
Right.
So
there you go.
Yeah, and I know I can only talk about my own portfolio, which has done exceptionally well, but I can't comment on how well the AOA as a whole has done because we just don't have data like that.
Well, we
John, a lot of groups are like that, Dan, and we're trying to get more and more groups educated and understanding the importance of collecting their own data and contributing to the ACA. It's an ongoing effort for all of us on the committee. John and I are part of, and so we're here to help. And if you and some of your associates have any questions about that and want to spend some time with me, I am all too willing to try and take some time to help you guys and give you some suggestions. In fact, I'll send you a couple notes on that a little later.
we very much look forward to when AOA can participate in that. You're one of the largest groups that's not participating, so we'd like to get you in there. And Rick's put an innovation forward that we're just piloting now, which might actually help solve your problem, which was the problem a lot of us as groups have always had, is that the data collection was done by us as volunteers and deal leads. And we didn't have consistent levels of engagement or deal leads, and it was really hard to herd all those cats. So we're trying a different thing now. Is we've created a simple spreadsheet form. In TCA, we turned it into a Survey Monkey, and we're sending it to the CEOs of the companies at the time we close while the information is still fresh. And we're finding they can fill it out. They can fill out this whole form in 7 minutes. It takes us a lot longer, and a lot of groups don't do it because of that. So that may be, if you want to think about, rather than getting it from your members, ask that same information from the companies you're funding. That's another way to potentially crack the nut. And we'd be happy to share that with somebody.
I'll send you some stuff on that, Dan.
Great. Well, again, on behalf of the Alliance of Angels, John and Rick, thank you so much. It's always been a pleasure working with you, and thanks for doing this for us.
Thanks for the opportunity. Have a great day.
Thank you, Dan. We enjoyed it very much.
Okay.